Hello and welcome to Dollars and Cents, the Australia Institute podcast where we're talking about just what the hell is going on in the economy. I'm Elinor Johnston-Leake, the senior content producer here at the Australia Institute, and as always, I'm talking to our chief economist, Greg Jericho. Hello, Greg.
Hi, Elinor. How are you doing this week?
What? That's my line.
I know. I was thinking about, I got to get him first this time.
I'm doing all right. Yeah. Busy and moving house, so that kind of sucks. But, you know.
Eleanor's got it. No.
I'm not buying,
still
renting again. But, you know, how are you doing this week, Greg?
I'm tip-top.
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 Indeed.
Really, really good.
Cheerio. Very
because as listeners will find out, yesterday a huge annual amount of data just got dumped on our laps from the tax office, and so it's kind of economist Christmas.
Yeah, well, spoilers. We'll talk about that later.
Yeah.
But first off, we're going to talk about the big thing that happened this week. The Reserve Bank met to...
Just thinking, yeah, everyone's going, yeah, that was the big thing this week. Not State of Origin, not the Socceroos, not
to me.
It was the big thing.
The team that I was assigned in the office, what do you call it? Like
the pool,
the
World Cup pool.
Yeah, the Côte d'Ivoire. They won.
Well, I got Saudi Arabia, so
well,
we're a draw. So
anyway, the Reserve Bank met this week to make a decision about interest rates, and they kept interest rates on hold at 4.35%, which is what most people were predicting, which is good. They didn't raise them again. But Michelle Bullock did say in her presser that the RBA is ready to raise rates again if they need to.
I want to be very clear that inflation remains too high. Reports that an agreement has been reached to end the conflict in the Middle East are welcome. If the conflict does end and the Strait of Hormuz is reopened, this should support the flow of commodities and lower prices. But this could take some time, and an orderly resolution is still not assured. Today's decision does not rule out further tightening in monetary policy if that is what is required to bring inflation down.
So I guess the message is don't get too comfortable, don't go splashing any cash. Is that what they're trying to tell us?
Yeah, look, you're right. Everyone expected the Reserve Bank to keep the rates on hold. You know, you look at the futures market, I think they were pricing in a 0% chance of a rate rise.
Very good. Yeah.
And yeah, she tried very hard in her press conference to say, oh no, we're still going to, keep a watch on things. We're a bit worried about excess demand. She loves talking about excess demand. The market's kind of not really believing her. Like if you go back to the May meeting where they did raise rates, the futures market was then predicting certainly another rate rise and maybe another two.
Yep.
Now it's maybe a 50-50 bet that there'll be even another rise at all. So this might be it.
Yeah.
And that's because of a number of factors that all had to also do with them holding rates this month. For example, unemployment went up to 4.5%. The GDP figures weren't great unless you were building data centers. Household spending's not flash. And yeah, they're making a deal over in Iran, but who the heck knows if that'll last? It's there's just not a lot of joy and optimism around. So why would you? And also, especially that raising unemployment, it doesn't seem like a good time to raise rates. So yeah, that's kind of what we're looking at. But you're right. Michelle Bullock was sort of like, oh no, I could still do it again. Well, obviously you could still do it again.
What do you think that the RBA just still wants to spread the message? Don't get too comfortable, or?
Oh, very much so. The RBA wants everyone to be more worried about keeping their job than arguing for a higher wage rise. They talk about in terms of they want to keep inflationary expectations anchored, as in they want people who are bargaining for wage rises, especially if you're doing like an enterprise bargaining agreement that's going to go for 3 years or so, to be thinking, oh no, inflation's going to be below 3%, so I'm not going to ask for a 5% wage rise, I'll ask for a 3.5% one or something like that. She doesn't want people to think, well, inflation's at 4.5%, 4.2%, maybe I do need a 5% wage rise to get over that. She wants everyone to go, no, don't do that. And a good way for people not to do that is for unemployment to rise. So you go, oh, God, things are tight. I better keep my job, not be too greedy.
Speaking of unemployment, knowing that the maybe often lesser looked at part of the RBA's mandate is to go for full employment. What's the messaging around that at the moment?
Well, you always have to remember the Reserve Bank. Full employment means the level of employment when inflation is below 3%.
Which seems arbitrary.
Yeah. That's what they have just decided, that's what full employment is. So because we've got inflation at the moment above 3%, what the RBA's definition of full employment means is a situation where there could be more people unemployed by the time we get to full employment.
More people need to lose their jobs before we get to full employment.
Yeah, it's such a – and it's the problem with how the RBA sees the entire economy. Everything that occurs when inflation is above 3% is kind of out of whack, is wrong.
Yeah.
Inflation is above 3%, therefore the GDP growth is too high. And in fact, Michelle Bullock said we really should only have GDP growth around 2%. Inflation's above 3%, therefore there's not enough people unemployed. Unemployment needs to go up.
It's inflation all the way down.
Yeah, it's inflation is the thing that they view as until we get inflation below 3%, things are out of whack. And always remember as well, the other part of the mandate besides the full employment is stable inflation. It's not low inflation. It's not inflation below 3%. That's not in the mandate. That's in their sort of statement of expectations that is decided between them and the Treasurer, where they basically say, and to achieve this, we will aim for inflation between 2 and 3%. But, if inflation is stable at 3.3%, well, it's stable. There's nothing wrong with the economy. There's no sense of, this is out of control. It's just that, that's where inflation is. So they choose arbitrary ranges and as a result take anything that is outside of that as needs fixing.
You mentioned just now that Michelle Bullock says, that the RBA said that the economy should only be growing by 2%. Can you just unpack what they were saying there?
Yeah. Now, remember, GDP growth is the size of the economy, how much we're spending, how much we're producing. And in the most recent figures, it was growing by 2.5%.
Pretty dismal, really?
Yeah. I mean, sort of the long-term average is about 2.75 to 3%.
Yeah.
So 2.5 is just a touch below. But as we pointed out in our episode on the GDP figures, the problem was not the big number, it was how we got there. Most of it was due to building data centers and buying machinery and equipment for data centers that produces no jobs, no growth in wages, no anything. And a lot of the profits are going to go offshore anyway because the IT and everything and the IP is all offshore. So it's not the same as Ford or Toyota coming and building factories here in Australia to build cars here in Australia. No, they're putting in a whole lot of IT stuff and
which boosts the
computer
GDP
chips.
number, but it doesn't
do anything.
Materially translate to benefits.
But she's saying that because, and they're talking a lot about productivity, because our productivity is low, anything above 2% means inflation will go up. And it's like, well, no, 2.5% growth, yes, that's above 2%. But actually what happened in the GDP figures was inflation in that period also slowed. So it's just, again, this, and I sort of looked back over the last 30 years, and it's extremely rare, really, for Australia's economy to grow by 2% or less. Historically, that is really pathetic. And for the head of the central bank to say, actually, that's as good as we can do right now. It's just, Christ, I know economics is a dismal science, but geez, that's really dismal. And again, it's purely because inflation is too high. Well, okay, what's driving inflation at the moment? It's not really our exuberant spending. It's things happening overseas. As we showed in our research at the end of last year, there was an increase in profit margins. It's like, what are you actually looking for here? What are you trying to fix? And So, look, at least they didn't raise interest rates. Good thing. Hopefully that's the end of it, because I certainly don't think we need any more, and I don't think we needed even the May one for reasons we have discussed many, many times.
Yes, go listen to previous episodes if you want to hear those. All right. Well, also this week, Greg, you and friend of the pod, fellow economist here at the Institute, Matt Grudnoff, appeared at the Senate Economics Legislation Committee to talk about the government's proposed changes to the capital gains tax discount and negative gearing. How was that, Greg? Did you have fun?
Oh, it was balls out fun.
Just you love having a chance to go on a field trip with Matt.
It's kind of insane how often Matt and I have now appeared before Senate inquiries talking about capital gains tax.
Yep.
Kind of hoping this one's the last one, because surely just pass the legislation, please. Can we be done with it? Look, it was good. You know, for listeners, the experience is kind of weird. It's a bit like a job interview. You're sitting across from tables of, and I think this case it was about 8 or 9 senators, a few Labor ones, a couple Liberal National ones. David Pocock was there, and they ask you questions. Now, some, like the government senators, because it's their legislation, they were basically asking, please tell us how good this legislation is and why it should be passed. And the Liberal senator, Claire Chandler was the main one, was trying to get us to admit that actually capital gains tax really didn't have any role to play in housing affordability. And we kind of, both Matt and I, pushed back on that a fair bit.
If these people are saving to buy a home, they're going to be far better off from not having to pay a fortune for the house and get into housing early, rather than the tiny amount that they might lose from additional tax.
The CGT changes in 99, you don't think some of those other levers might have had a bit more of a cumulative impact on property prices than something that happened 27 years ago?
Well, the problem is the thing that happened 27 years ago is still happening. It's still here, and in a sense, I would say it was, ground zero.
Interest rates might have something to do with
Well, interest rates have gone up and down over that 26 years. Similarly, migration, you could say, had something to do with it, and yet we had the strongest increase in price rises when migration was zero.
Yeah, there were some interesting questions from her. Yeah, just asking, how do you know that it was capital gains tax, that these tax systems that caused the housing crisis, and it wasn't all these other things.
I mean, this is based on some work or writing by a couple of journalists who have been published in the AFR, who are trying to say, we've ran all the regressions, and point out, no, there's a whole lot of other things at play. There were banking regulation changes. There was the opening of the financial system in the 80s. There was, just a whole range of things, and it's all combined. And so when you just take everything into account, the CGT changes, they barely had any role to play. And
so what did you have to say?
Well, my point was that, she was quite right to say that some other countries' prices had increased sort of roughly the same time, not precisely. UK's house prices started going up a bit earlier, America sort of around the same time. But what we were able to point out was, but Australia's done worse. Australia's really gone backwards. And yes, there were things like the liberalisation of the banking system by Paul Keating and everything, and that did cause a bit of a asset boom in the 80s. But when you look at the relationship between house prices and household incomes, it was a blip.
Yeah.
It was a blip that then didn't do anything for over a decade. And then in 1999, the CGT changes came in, and suddenly housing became a lot less affordable. And our point has always been when, and she, for example, said, how can you blame it on something that happened 27 years ago? And I'm like, well, because it's still happening.
Well, that's great.
It's not like there was they just had a 50% discount on capital gains for 1 month
1 year.
in 1999. Get in before the end of year financial sale on capital gains. I was like, it's still here. It's having an impact. And, we've always acknowledged things like first home buyer grants, things like home builder, things like the 5% deposit guarantee. These are all adding to the problem. But the reason why those things are being done by governments is to try and counter the distortion of the capital gains tax discount that gave investors such a leg up. And also we point out, well, look, if it's not having an issue, why are we seeing all these reports already that investors are leaving in droves? You know, that auctions are falling, that house prices are moderating, you know, flatlining, some even going down. Like, either that is having an impact or it's not. You know, pick one. You can't say that, oh, look at what's happening to the market. It's you know, investors are all leaving. Well, okay, why do you think they're leaving? And if it's because the capital gains tax discount and negative gearing is no longer there, well, then you can't go back and say, oh, well, then it had no impact over the last 27 years. You know, it was weird logic. But, always fun. And but hopefully Matt and I don't have to go and talk about capital gains tax discounts ever again at the Senate.
Going back, you mentioned briefly sort of the global comparison in that, you know, there was the question raised, other countries around the world have experienced a housing crisis in some form or another. House prices have gone up around the world. How do we know it's like Australia's any different? And I can't remember if it was you or Matt. Sorry.
It was Matt.
Matt, shout out to Matt, who gave a direct comparison in terms of the size of the growth. Can you just give us the numbers there?
Basically, you know, Australia's price have gone up sort of fivefold. Well, America, it's about double. You know, you know, there's been a lot of similar impacts around the world, but Australia's been so much worse. And also other things you look at. The amount of national income in Australia that is devoted to housing stock compared to America is, you know, we're like double. Yeah. And that's because we've got a tax system in place that was incentivizing investing in housing, a very unproductive thing. You know, if I buy a investment property that was built in 2005, well, I haven't created any new work. No. I just bought it and created some wealth for myself. Yeah. You know, that's not productivity. We should be trying to get people to invest in things that will actually produce work, produce labor, produce some production. And unfortunately, we've had 26 years of doing the opposite.
Matt, maybe now some of those investors that are leaving in droves will invest in something more productive.
Well, I mean, and also as Matt pointed out, because we were also asked, oh, what about housing stock? Is this going to destroy housing stock? And remember, the tax changes for new builds has not changed at all. You can still negative gear a new house. You can still get a 50% discount on a new house.
Which would increase supply.
Yeah. So as Matt pointed out, at worst, it won't change anything because nothing has changed.
Yeah.
You know, so if you still think housing's a good place to invest, you know,
build some.
You can still do it. You just can't do it by buying a 20-year-old property and renting it out and going, oh, I've reduced my tax. You know?
Yeah. I have noticed there have been some sort of interesting, I suppose you could say, marginal takes about, you know, reasons why arguments against the changes to the capital gains tax discount. There was some story in the Australian today about Pokémon cards. I don't really know how that relates. Can you tell us about that?
It's because the discount has been taken away for all investments. So if you buy shares and things like that and you hold those shares or any asset for more than a year, you used to get the 50% discount. Now you don't. And so what we see is those who are opposed to the tax laws are coming up with the most obscure sort of things to point, oh, this is terrible. If you've got Pokemon cards, you're going to have to get them valued because...
Like if you sell them?
Yeah, because if you're a Pokemon card collector, they have a value.
Yes.
And if you would just sell your entire collection, you would make a profit from them. And now you're going to have to get them
value. But I would imagine that if someone had a sizable Pokemon card collection and was selling it, they would be getting, if they weren't smart about it, would be getting it valued anyway.
Yeah.
Also, it's an interesting point because there's just Pokemon cards have become there's been such a problem with scalping in Pokemon card buying. So now it's like, you know, there's all these investors buying up these Pokemon cards and it means that these first-home buyers or young kids can't afford these.
Exactly. Pokemon cards were not devised for
as an investment
Gen X
strategy.
people to fund their superannuation. It was for kids.
Yeah.
And you're right. It's kind of a bit like the first home buyers. It's
similar.
like, and we're seeing other examples reporting of an 18-year-old who was looking to buy his first investment property and now is thinking otherwise. I'm like, well, for a start, you're 18, mate.
Yeah.
But also, what about the rent vestors and all this? Like, and the thing I kept coming back to in the Senate hearing was pointing out, look, what is the problem we're trying to solve here? We don't want to be in a situation where you have to invest in EFTs or in shares or something to try and get enough money for a deposit. We want saving for a deposit to be within reach for people just saving, you know, maybe having term deposits, but no one in the 90s, I can tell you for a fact, was thinking, oh, hell, I better be investing in shares just so I can one day get a deposit.
Yeah, or I'd better get into rent vesting.
No, we got to get back to, we want housing to be affordable. What's the best way to make housing affordable? Not how can we tweak the tax system so people can have a chance to buy these extremely unaffordable houses. That's, completely wrong way of thinking about it. And you're right. If you are a Pokémon collector or if you're a stamp collector, don't bother. Your stamps are worthless.
Or Beanie Babies.
I'm sorry. It was a nice investment strategy. It did work. Shout out to my dad. Look, it's, if you are an actual collector of something like that, of actual real assets that are worth real money, as you say, you're already worrying about valuing of these things because you're worrying about insurance. You're worried about, it's a thing. So these are made up problems just to make it seem like, these tax changes are really complex and convoluted. It's like, get over yourselves. What you're really doing is trying to ensure that extremely rich people can keep getting a lot of earnings tax free, basically.
All right. Well, speaking of tax, Greg, the ATO has released the tax return data for this year, which gives us a good look at how much people earn or do not earn in Australia. What does this year's data tell us about how much Australians are earning in 2026?
Yeah, it's basically what these stats are is every question on your tax return is a bit of data. So we've got not only how much do you earn, what your occupation is, because you put in your occupation, where you're from, gender, age, what type of deductions you do, whether it's charities, whether it's work-related, how you got your income, whether it was salary, whether it was capital gains, whether it was in a trust, whether you got franking credits, what your HEX debt is. All of that stuff, everything in there. So, we're talking megabytes. We're talking a lot of data here. We're spreadsheets that have far too many columns, and it's one of these things where
like
it's an overload of information that I love but also hate. What it does tell us is it gives us a breakdown of things like total income and taxable income, which enables us to show that, there were 90 people who had a total income of more than $1 million who actually paid no tax, who were able to get themselves below the
90 people.
Yeah, below. They were able to go from having a total income of $1 million to below the tax free threshold, which was very clever of their accountants. Well done them.
Funny how that worked.
It was quite funny that funny in some ways that there were 91 millionaires who were able to get below the tax-free threshold, but one of them had to pay some tax. So one of them had to pay $769 in tax.
Gosh, imagine being that one person at the Millionaires Club.
You'd feel really disgusted with yourself.
Fire your accountant.
What it also, a good thing that it does is look at things like gender breakdowns by occupation. And we, for example, know that in 95% of all occupations, men have a higher average income.
But that 5%?
That 5% is Well, you would think, for example, that 5%, of course, would be in, say, the most female-dominated profession, midwives.
Mm.
But you would be wrong. Midwives, women, the average salary for women midwives is $76,399. For men, it's $97,633. So a little bit of a disparity there, even though there are 22,200 women midwives and only 411 men ones. You know, some of the highest disparities in wage, obviously in sports, cricketers is one of them. Big disparity in what men and women cricketers are paid.
Yep.
But unfortunately, as I say, 95% of all occupations get the salary. And I always like these tax stats because you can't hide behind but they're paid the same hourly rate or whatever, because what it looks at is, okay, let's say you are a journalist, for example, and journalism is one that will be there. It's like, okay, well, who's getting the hours? Who's in the more senior roles?
Mm.
Because that all factors into what's your annual income.
Yeah.
Because that's what really matters. Okay, we're all earning $50 an hour. Great. Who's getting 38 hours a week and who's getting 20 hours a week? Because you ain't on the same income.
Who's getting the promotions?
Yeah, who's getting the promotion, all that. Also, it lets us know where you lie on in terms of taxable income.
Yeah. I mean, because we talk a lot about, the rich, the wealthy, sort of vague terms.
So what is rich?
What is rich?
Okay, well, let's first start median. So at the 50% mark, if you earned, your taxable income was more than $71,224, you're in the top half.
Yep.
So that's the median. If you're below $71,224, you're in the bottom half.
Is that just full-time or is that all?
That's all income.
Yep.
All income, part-time work, full-time work. That's if at the end of the day you looked at your tax return and you put in how much income you earned in taxable income, $71,224. Now, let's go up the other end. The top 10%, how do you get into the top 10%? Well, you earn more than $166,277.
All right.
You earn more than that, you're in the top 10%. So that really gives us sort of a guide. Top 5%, it gets high pretty quickly. Top 5%, you're talking $216,910.
That is a lot of money.
Yeah.
Yeah.
And yet we still will see articles like, does earning $200,000 make you rich? Well, if you're earning $200,000, you're earning more than 95% of all Australians. So I think maybe you can start calling you rich.
Yeah.
To get in the top 1%, now this is where it gets a bit tricky because the ATO splits up for men and women. And generally around the middle, there's not too much change. But once we get to the ends, there is a bit. The top 1% for men, the average income is $973,755.
Yeah,
for women,
I think that is rich. Yep.
For women, it's $958,000. Still rich, but a bit lower.
Gosh.
And if you're talking sort of the median amount, because averages take into account those who really get a hell of a lot, the median amount is $615,000 for men. For women, it's $598,000. So basically, if you're earning more than $400,000, you're basically in the top 1%, really. You're sort of around there. Now, down the other end of the scale, what puts you in, say, the bottom 20%? If you're earning less than, say, $42,000, you're in the bottom 20%.
That's more people than I would think.
Yeah. It really gets across. And it's the thing I like about these figures is, we often hear about average weekly earnings and, these taxes will ensure that a male on average weekly earnings, which, is above 100,000 now, they will be taxed less. So this is really good for middle Australians. Like, okay,
let's
just
be clear about what middle is. Yep.
And realizing that there are a lot of people who are earning less than $50,000. if you earn less than 50,000, you're probably in the bottom 28%. So about 28% of Australians earn 58%.
Almost
less
a third.
than 50. Yeah.
Yeah.
There's a lot of confusion about what people earn. And I love these figures because this is what they earned. This is what they took home. If you work part-time, you don't get to say to your landlord, oh, sorry, didn't get many hours this week, I'm not paying you. It's you got to, annual income is really what matters. And that's why things like the gender pay gap on annual income is always a lot more than if you look at hourly rates of pay. It's why when you look at who is actually earning, 45,000, that's where the second tax threshold kicks in.
Yeah.
And we're talking, around 25, a quarter of Australians earn less than that.
Yeah. When you see all these, when you go on social media and see comments of people saying, oh, 100,000 isn't much anymore, doesn't go far. And I'm like, look, maybe in some cities, but if just knowing that almost a third of Australians.
Yeah. Well, if you earn 100,000, you're basically in the top 30%. So 70% of Australians earn less than 100,000.
Yeah.
Now, also remember, these are always individual figures. So, if you got two people earning 100,000, that household is not in the top 30%. They would be in the top 10, 5% because it's very rare to have two people earning that much amount. But it just shows that when you see people who are complaining about, the tax rate for people on 190,000, that needs to be raised because of incentives. And remember, 190,000 is where the top tax rate kicks in. And to earn that, you got to be in the top 5%.
Yeah.
So, let's just have some context, shall we say, to these figures. But if you want to read more about these, Matt and I are absolutely going through them, and we'll be putting them all on thepoint.com.au. We'll be looking at things like PRT because those figures are in there as well. There's company tax stuff. There's negative gearing stuff. There's everything there, and we will be churning out the columns, churning out the articles, and you can find all the data there.
Very good. All right. Well, I reckon that's probably all we've got time for today, Greg.
It is, unfortunately, Elinor, but rest assured, listeners, we will be back next week. And
we sure will.
I had a sneak peek, and next week, huge week. One, we've got Parliament back, so the live blog will be going madly on the point with Amy Ramakis. There's new inflation figures out for the June quarter and the June month. There's also data on Australian industry. There's just going to be lots going on. But this episode of Dollars and Cents was recorded on the 18th of June, and some things may have changed. As I say, if you want to read more about the tax data, about CGT change, about everything else going on, not just with the economy, but with foreign affairs, with democracy, with climate, everything, head on over to thepoint.com.au. And if you'd like to read more about what the Reserve Bank's doing, just head on over to my column on the Guardian Australia site. If you want to support the research Powerful Interest Fear, you can also make a tax-deductible donation to the Australia Institute's end of financial year appeal before 30 June. You can give now by the link in the show notes. So if you're able to do that, it's much appreciated. As always, music is from Blue Dot Sessions. Everyone, have a great week, and we'll see you all next week.
See ya.